Now we're ready. So I'm gonna start by finishing these notes on when do companies need issue equity. That's what I called mini case 2. And just to recap, right, the main topic here is to talk about the exceptions to the rule, right? So we learned that companies do not typically issue equity to finance investment, except in certain situations when there are specific motivations to issue equity. So it's not the standard source of funding for companies. We talked about M&A deals, and there the idea that we covered is that companies issue equity because of over leverage, right? To mitigate the increase in leverage that is caused by large acquisitions. So we talked about the AT&T DirecTV case, right? In which we used the trade-off model to show that if AT&T had paid in cash, then the company would likely have become over-levered, and that's part of the reason why they chose to use equity. And that's the quick summary of that. And then we started talking about secondary equity offerings, right? Which is when a public company with traded shares issues new shares to investors in exchange for cash, right? And like as we discussed yesterday, the empirical evidence suggests that investors typically react negatively to SCOs, and then the two cases in these notes, there's actually 3 cases because there is one on liquidity and 2 on windows of opportunity, right? So we talked about liquidity as a motivation for equity issuance, which is part of the story of COVID. During 2020, because of the lockdowns, companies had negative shocks to profitability, right? And they decided to issue equity. Some of them issued equity to raise capital. Ruth's Chris is one example. That was our first case, right? So the point here is that let me summarize using this slide. The stock price, right? So the point here is that the company decided to issue equity at that date when the stock price was $9.5 a share, right? But the equity, the offering was priced at $7.75. We talked about the role of the investment bank that has to intermediate the offering, right? And the investment bank prices the shares at a lower value because in anticipation of the fact that the stock market will probably react negatively, right? And then it becomes almost a self-fulfilled prophecy, right? And then what happened after the issuance is that the stock price did drop, and then in the aftermath, right, the stock prices went back up. There was a very quick price reversal, and the story that one of course, we never know why stock prices are moving. But one possible explanation that we discussed yesterday is that the market was reacting positively to the inflow of liquidity, right? The market realized that this is a company with strong fundamentals, and it was probably a good idea for the company to raise capital at that time, and the price went back up. Okay, so that's the summary of what we did yesterday. Regarding equity offering. Okay? Any question on these before we go to the next example? Okay. All good? So today we're going to start talking about Our first case here is going to be an example of a situation, another situation in which companies issue equity. Okay, and I would say this example is probably less common than the other one, the liquidity constraint story that we talked about, but it has happened recently in the US market because some companies have become clearly overvalued by the stock market. So it's usually hard to prove. You probably talked about company valuation in a previous class, right? So it's not trivial to prove that a company is overvalued, but if you follow the U.S. market, what has happened to companies like AMC and GameStop is that they have been targeted by retail investors, right? Using social media and say, okay, let's buy the stock of GameStop without really, thinking about what the price should be, what the fundamentals are, right? GameStop is a company that doesn't really have a lot of growth opportunities, but the stock price just increases a lot. And where we're actually going to talk about another example, a related example, which is AMC, is another stock that has been targeted by retail investors. And this one is easy to see that really doesn't have, it's a movie theater. Okay, this is not yesterday we were talking after class, people were asking me about Tesla, is Tesla overvalued? With Tesla it's a little bit harder because the company does have a lot of growth opportunities, and who knows, right? Maybe they will take over the entire car market and etc. But now we're talking about movie theater, right? I mean, how much, if you just think about future growth opportunities, how much can a movie theater cash flows increase? And in this case, it becomes, we're not going to do the valuation analysis here, but it becomes very straightforward to prove, to convince yourself that this company is overvalued. So the fundamental value, if you do the analysis, the valuation of the company using discounted cash flows, which is probably something you learned in a previous class, even with the very optimistic assumptions about future growth, etc., and discount rates, it's hard to get a stock price higher than $15 a share. Okay, that's kind of a very optimistic fundamental valuation. But as you can see there, during 2021, because of this wave of retail trading, the stock price of AMC was trading at $60 a share. So it was really clearly overvalued. Okay? So now we are in a situation in which the company's stock price is high, right? And the managers of the company know that. And then it becomes an interesting proposition, right? To sell more equity, you raise cash, and then you can pay dividends to shareholders. You can use the cash to invest in the business. There are other uses for this cash, and this is what AMC did. They decided to issue equity on June 3rd, 21. That's when the offering was announced, right? They sold a number of shares to 11.5 million at a price of $50 each. Okay, raising that amount. Okay, so quite a bit of money, right? And the interesting thing. Let me see if I have it here. Yeah, we'll talk about that later. But I have a slide on that later. But if you read about this offering, the managers of the company actually decided to warn investors and tell investors not to buy the stock. They said, look, we believe that they almost telling investors not to buy the stock because there are risks, etc. The stock may be overvalued, but then people bought it anyway. So, and what I want to do here is talk a little bit about the mechanics, right, as we did with the other example, and to show to show you, using our simple calculations that we learned yesterday, right? That this issuance does in fact increase the fundamental value of the company. So when you're issuing shares at a price that is higher than what the price should be, right, then you're going to increase fundamental value. Okay, so it's as we discussed it yesterday, the NPV of issuance is zero only if you issue shares at a fair value, right? So this is an example of a situation in which you're issuing shares at a price that is higher than the fundamental value, and this is going to increase the fundamental, value of the company. So that's what I want to do, is just to think about the mechanics here and show you. Okay, so the company had about 500 million shares outstanding prior to the issuance. So if you believe that the fundamental value is $15 a share, right? Like I said, this is an optimistic valuation. Then you would get a valuation for AMC of 7.5 billion. So just multiply the stock price by the shares outstanding. Okay. So what we're going to do is to figure out how does the issuance affect the fundamental stock price, right? And it's very easy to do this using the calculations that we did yesterday, right? So again, what happens in a share issuance is you get cash, right? So AMC got $587 million in cash, and then you issue more shares, okay? So that goes in the denominator. If the shares were being issued at $15, right, then what would happen is the stock price would remain constant. That's the calculation we did yesterday, right? Because the cash coming in exactly compensates for the number of shares issued. But in this case, the fundamental price increases, right? It's increasing to 15.8. And that gain, right? So the NPV, if you want to think about an NPV, a net present value per share, it's almost $1, right? That the company is gaining from shareholders who are buying the stock at an overvalued amount. Okay? So the new shareholders are paying too much, right? And the existing shareholders gain at the expense of the new shareholders, right? Provided that the existing shareholders agree with the valuation. So now here we have the tricky situation because some of the existing shareholders are willing to buy the shares at a very high price, but if you believe that the fundamental value is $15, then this is clearly a positive NPV action. Okay, so the management, for example, the CEO, the top management are shareholders of the company, and apparently they don't believe that the stock price should be that high, and and that's why they did this offering. Okay, so this is kind of the reverse example of what we did yesterday, because now the stock price is increasing with an equity offering. Okay, everybody, did you understand this calculation here? Right, it's similar to what we've done. Okay, so any question on this? And here's the warning, right? You can read this. This was in the offering. The market prices and trading volume of our share have recently experienced and may continue to experience substantial volatility, which could cause purchasers of our stock to incur substantial losses. So this was included in the offering. So, the company is clearly telling investors that there is a high risk of participating in this offering and buying shares. I think this is just the company is telling investors not to buy the stock, but they still do, right? So, and then the company takes advantage of that, right? So, and if you look at the aftermath, if you look at the stock prices of the company, AMC closed on June 3rd after the offering at $51 a share, right? But then it went up again. Okay, and this is, and as we discussed it before, you never know why stock prices are going up or down, but this is showing that in some cases the stock price does go up following an equity offering, right? So it's another example showing that dilution is an illusion, as I like to say, because here there is apparent dilution, right? There's more shares being issued, but the stock price is actually going up. And the fundamental explanation for this is maybe the company is gaining some value, but in the case of a company like AMC, it's hard to to really determine what is what is determining the stock price in the market, because this is probably a crazy there's some crazy trading going on here. Okay, but this is an example of the other situation in which companies issue equity, and as I said, this is not so common because in many cases like Tesla, it's difficult to prove that the company is overvalued. However, if you follow what's been happening to Tesla, there was some sale of stock by insiders, right? Elon Musk just sold a big stake in the company, and some investors see that as a signal that the company is overvalued. That's why he's selling stock to raise cash. It's a good time to do it, given the current valuation. Okay, so this is the idea. Any question on this example? All good? Okay. Let's talk about the other major exception to the rule that companies don't issue equity to finance investments, and the other major exception is the venture capital industry. Okay, and we're going to try to learn why it is the case that startups, companies financed by venture capital, typically are funded with equity rather than debt. Okay, so I like to start with this because it shows that venture capital fund, it really is very similar to private equity company. We actually showed exactly the same organizational chart yesterday when we were talking about private equity, right? Private equity firms, they specialize in doing leverage buyouts. So we talked about Dell, right, and others, and ADT, right? So those companies were acquired by a private equity fund, and then in the private equity fund you have the general partner who selects investments, then you have the limited partners who provide capital, right, and they form the fund, and then the private equity fund selects investments. So in the case of private equity, the investments are companies like Dell and ADT, right? So a venture capital firm is very similar. You have a general partner as well. You have limited partners who provide capital to the firm, cash, right? Invest in the venture capital fund, and then the venture capital fund selects investments. Okay? So what's the difference between venture capital and private equity? Let's start with that question. They look very similar, right? What's the major difference?
Venture capital invests only in the startup.
Yes, right? The difference is here. It's the type of investment, exactly, right? Venture capital invests in young companies, growing companies, right? And as we learned yesterday, private equity targets more mature business that have strong profitability, right? Because otherwise you wouldn't be able to repay the debt. And in the case of a venture capital fund, they are investing in startup companies, right? And a very general idea in corporate finance is that the type of investment determines the type of finance, right? In the case of leverage buyouts, we learned yesterday that because of the type of investment, those deals have to be financed with significant amount of debt, and in many cases the companies become over levered, and what the private equity fund does is to try to mitigate the effect of financial distress on firm value. Okay? In the case, and now let's think about startups. This is a very different example because the type of investment is fundamentally different. Right now we're talking about the typical startup is a company that has no profits, right? No track record. Many companies it's just an idea, right? You have a product, a prototype, and sometimes you haven't even brought it up to market yet, but the company needs to raise capital from investors in order to create the product, bring the product to market and make money, right? So the value comes from the potential for future growth, okay? So let's think about the following question. Again, what we can do when we think about financing a startup, which is our focus here, like, as we did yesterday, this is not really a class on venture capital per se. We're focusing on the financing aspect, right? Like we did with M&A, we're not really talking about the other aspects of M&A. We're focusing on the financing. Here's the same thing. What I want us to think about is the capital structure question that we were talking about yesterday, right? So if you think about this, the type of investment, right? And you bring that to the trade-off model of capital structure, right? I think we can come to a very clear conclusion here, right? So if you use the trade-off model of capital structure, right, and you think about an investment, right? Now we're financing an investment like that with zero profits, right? What should be the optimal capital structure and why? And think about that question. What's the best possible capital structure for a company like that? Is it 30%? Right? Yesterday we talked about the 30% number. That's kind of a benchmark for large public firms in the US. What about the startup? What do you think? More or less than 30? Less. Right? What's the optimal? Zero. Yeah, great. Okay? Why? What's the benefit of issuing debt? Tax shields, right? So,
no profit.
There's no profits, right? If there's no profits, there's no taxes. There's nothing to shield. Right? So because there's no profit, the tax benefit of that is not there. Right? What about financial distress? Very high, because these are companies with the value comes from future growth, right? If the company goes bankrupt before you develop the product, then there is no cash. Then you know for sure you destroyed 100% of the value, right? So you can't really allow. You have to try to minimize the risk that a startup goes bankrupt, right? And by adding debt to the capital structure, you're not creating any value. You're just making more likely that the company is going to go bankrupt, right? If with no profit, the only way that a startup could repay debt is by issuing more debt, right? So it becomes a Ponzi scheme, okay? So in this case, again, the trade-off model gives us, I think, a very clear answer, and it's an answer that is consistent with the data, right? Startups, as we're going to see in a second, don't really have debt. They issue equity. The venture capitalists hold equity in the company, right? So the answer here is, I think, pretty clear. That's how the picture would look like, right? For companies like startups with no profit, right? It's just a straight line down. The more leverage you have, the higher the leverage, the lower is going to be the value, right? So that's an example also of something we talked about yesterday. The 30% number doesn't work for everybody, right? There is variation in what the optimal capital structure is. It is a useful number when you think about large public companies like AT&T, all the examples yesterday, right? AT&T and ADT and Dell, etc. That 30% benchmark was useful to think about the financing, right? But in this case, it's very different, right? So clearly the optimal is 0. So this company should try to finance themselves using different types of funding. Okay? So that's what happens if you look at the data on venture capital firms. And here we have a similar problem to what we discussed yesterday. It's not easy to give examples because there is no data from these companies. So you can't just open the standard database and find data on startups because these are private firms, and you would have to ask the venture capital fund to give you data, or the entrepreneurs. You don't really have good data on these types of firms unless you collect it yourself from the fund. Okay, but it's based on some academic research and the examples that we know. It's pretty clear that venture capitalists fund these companies by holding equity, right? So the startup issues equity, and then the venture capitalist holds equity in the company. Okay? But there is a little bit more, in terms of the financing, because what we know from research and the contracts, that there is a very famous paper in finance where the authors studied venture capital contracts to try to see what type of security are they actually issuing, and what that research has shown is that venture capitalists do not really hold common equity. So it's not shares as like AMC issued common shares to investors, right? Venture capitalists are going to hold a different type of equity. Okay, and this is related to what we talked about yesterday, but here it's going to be for a different reason, right? If you remember the leverage buyout example, we talked about the fact that private equity funds like to issue preferred equity sometimes, right? So what's the rationale there? Let me see who remembers this. Why do private equity funds like preferred equity? What's the reason? Anyone remembers that? In the case of ADT, for example, right, they issued almost $1 billion in preferred equity.
Secure dividend.
Yeah, this is one characteristic of preferred equity is you get priority. That's going to be important here, but that's not the reason why. If private equity funds want priority, they can issue, right? Which security will give them even more priority? Debt, right? So debt is senior to preferred equity. So if the issue is priority, then they would issue debt. Why do private equity funds like preferred equity? Let's see who remembers that. What's the key feature that is actually there in the slide?
The payments.
Yes, right? The payments can be postponed. Okay? So preferred equity does not create financial distress. Okay? But here, this is not the main explanation for why, it's part of the rationale, but if the only concern was to avoid financial distress, then the private equity fund not the private equity fund, now we're talking about venture capital, right? So if the only concern of the venture capital fund were to avoid financial distress, they could hold common equity. Right? They just hold common shares, and that creates no distress whatsoever, right? Because the company doesn't have to pay dividends. So the venture capitalists could hold common equity, and then maybe make money when the company goes public or something, right? Here, what the academic research suggests is that the key feature that that explains why venture capital funds like to hold preferred equity is the priority, right? So the typical structure of a startup is, you don't really have minority shareholders yet because the company is not public. The major shareholders are the founders, the entrepreneurs, right? And then the venture capital fund, okay? So what happens in a startup is that the priority, so if the venture capitalist holds preferred equity, right, that gives the venture capitalist priority over the founder, right? So if you remember what we discussed yesterday about preferred equity, you cannot, so the main feature is that you cannot pay a dividend to the common shareholders if the preferred dividend is not fully paid, right? So the preferred equity has priority over the common equity. So the way that a startup is typically structured is the founder holds common equity and the venture capitalist holds preferred equity. So that gives the venture capital, it's a little bit more like a debt claim, right? So you have priority, and for example, if the company is liquidated and there are some assets that are worth something, right, those go to the venture capitalist and the founder gets nothing, right? So this priority feature gives some security, right, to the venture capitalist and, reduces the risk of the investment a bit. Of course, these are still very risky investments, right? But the preferred equity does give priority to the venture capital. Okay, does that make sense? Any question on this? Okay, but that's not the end of the story. So let's just understand the preferred. So preferred equity is like that, right? So really what the venture capitalist is trying to do is to get seniority here. Okay, but at the same time, it's a type of seniority that does not cause financial distress, as we discussed it yesterday, right? You don't want to impose financial distress on the company. So preferred equity is like a perfect security because it gives priority to the venture capitalist, but it doesn't really cause financial distress. The venture capitalist can always wait, to liquidate, it's not going to force liquidation if the venture capitalist believes that the company is worth, that there is some value in the future. Right? So it gives that financial flexibility. You have priority and financial flexibility. Okay? But there is a problem, right? Which venture capital funding has to solve as well. And the problem is that, as we discussed it yesterday, preferred equity has a fixed return. So for example, if a venture capitalist investing $100 million in a company, right, the return of preferred equity is going to be a fixed return, like 10% or 7%, like the example we calculated yesterday. There's going to be a dividend yield, right? And then the problem is that the venture capitalist, wants to, the main reason why these investments are being made is because of the future potential, right? So if you happen to invest in a venture that becomes the next, so the example here is Airbnb, which is one of the most successful recent ventures, right, in the travel industry. Okay, then the preferred dividend is not going to give the venture capitalist a sufficiently attractive return, right? So what happens then? How can you solve this problem? How can the venture capitalist share the gains of the most successful investments? What needs to happen here?
Increase the dividend.
Yeah, you could increase the dividend, right? But that's maybe a more complicated. There is a simpler way of doing it, which uses some. I think Professor Salve talked about some of these type of securities in his part of the course, right? Which is the use convertibility features. Okay, so it's a very clever way of doing the same. So you want to increase, right? So if the venture is successful, you want to increase the payoff for the venture capitalist rather than just give that fixed return, right? So the way that they do this is to use convertible preferred equity. Okay? So the convertibility, what happens is the preferred equity is converted to common equity. So at a certain point, and this is all specified in the contracts, etc., the convertible preferred the preferred equity that the venture capitalists hold converts to common equity, and at that point the venture capitalist just holds a certain stake in the company. So you become a common shareholder. Okay? So if the company goes through an IPO, for example, at that point the venture capitalist is typically holding common equity. And then, if there is a huge payoff, then the venture capitalist is going to get a share of that payoff. Okay? So now, convertible preferred equity is tailor-made for this industry. And it's interesting because it's probably the only industry where you see a lot of convertible preferred equity. And it is also the most common form of financing based on the academic research I was talking about. People who got the contracts and see how do the contracts look like. And it's the most common type of security that venture capitalists hold is convertible preferred equity. It's really tailor-made because you have, at the same time, you have priority on the downside, right? You have the debt-like feature. And then on the upside, you have the convertibility, which assures that the venture capital fund is going to share the gains of the successful investments, right? Does that make sense? Any question on this? Okay, so it's a type of equity, but it's a very specific type of equity that they use in these to finance these ventures. Okay. And then the other, as I mentioned yesterday, the other major exception to the rule that companies don't issue equity is actually related to the venture capital industry, because it is one of the most common ways that venture capitalists cash out of their major investments, which is initial public offering. Okay, the initial public offering is right the situation. That's the first time that a private company issues equity in the market, right? So a successful venture like Airbnb, right? I think that's the example we're going to give here. If at some point it becomes worthwhile for the venture capitalist to list the shares of the company in the market, right? Because then the venture capitalists can cash out of the investment, right? You sell shares to investors, and then you can cash out and pay your limited partners, right? Remember that the venture capital fund has the investors and it has the limited partners who want to get return on their investment, right? So the venture capitalists can cash out by selling shares, and the company, right? The company, the venture who is going public can raise cash as well. Right? So the IPO is a common way for venture capitalists to cash out. Of course, it's not the only way, right? So there is also fund-to-fund transactions, right? So you don't necessarily need to take a company public to raise cash. And what has become more common in recent years is issuing equity in the private market. So the venture capitalists can get private investors to invest in the company rather than issuing shares in the public market. Okay, but the IPO is a common way, and I wanted to give an example of an IPO for you to see how the numbers look like. This is the Airbnb IPO that happened very recently in December 2020. We don't really have the data on the initial contract, right, and what was the return of the venture capital fund, etc. Like I said, this initial data is buried, in the fund, so we don't really know. But once the company goes public, we have some information, right? So the IPO of Airbnb happened in December 2020. Right? The IPO was priced at $68 a share. And they sold 51.3 million shares which then means that if you do the math there, the company raised it $3 billion, right? $3.5 billion. And here you have the structure of how an IPO is done is actually not that different from the SEOs, the seasoned equity offerings we talked, the secondary equity offerings we talked about yesterday, right? So what's the role of the investment banks in an IPO? What do they do? In this case, this is a much more, right? This is a much more significant event for the financial industry than the equity issuance by Roots that we talked about yesterday. So you can see that now we have the top investment banks involved in this, right? So it's Goldman Sachs and Morgan Stanley who were the investment banks involved in this IPO, right? So what do the banks do? It's similar, right? So you remember what's the role of the banks in an SEO? Yeah, the intermediate, right? So they're essentially buying the shares, right? So it's what we call a commitment offer, okay? So the banks are committing to sell the shares at that specific price, which, really, if you think about the economics of this, really what's happening is the banks are buying the shares from the IPO firm and then placing it in the market at that price, right? So at a negotiated price. So the bank is also selling the shares at the negotiated price. Okay, and then the bank, in this case, the bank makes there is a fee, right? The bank makes the banks make money by charging fees, etc. Okay, so here's what's here's a feature of initial public offerings that is important to know, which is what we call IPO underpricing. And again, this is going to be similar to the example that we talked about yesterday, but there is a little bit of a different feature here. Okay, so when you look at and using Airbnb as an example, right? When you look, so we can, after the company becomes public, right? Then you can see what happened to the stock price, right? So the stock was issued at $68, right? And then you can see, okay, what happened after, in the first trading day. And in the case of Airbnb, what the data shows is the stock opened at $146, right? It seems good, right? So the stock went up, stock price is going up, it's good. But actually, finance academics think of this as a problem, right? Why is this an example of underpricing? What's the problem here? Who's making, right? So the investors who participate in the IPO are buying the shares at $68 from the company and from the investment bank. The investment bank is not making money here also, right? But then, people are willing to buy shares at 146. Okay? So why is this underpricing? What's the idea here? So if the stock price is worth 146, how much should what should have been the price of the offering? Should have been closer to that, right? So the company, if you think about the economics of this transaction, right? What happens is, if you think about what's happening, Airbnb is leaving money on the table, right? Because you sold 51, you sold a large stake on your company at a price that is $80 a share lower than what turns out to be the market price. Right? So you sold shares at a price that is too low. And the company could have raised $4 billion more if the IPO had been priced at the market price. Right? It's a lot of money. You basically, the investment bank and Airbnb left $4 billion on the table. Who's making the profit here? The investors, right? The investors who were given shares of the IPO are making a bunch of money, right? But the company, Airbnb, is losing, and the investment bank doesn't seem to be gaining either, right? Because they're selling the shares at that price. The investment bank is not retaining shares. That's not how the deal is structured. Okay? So it raises an interesting question, right? That if you're wondering, oh, maybe this is an extreme, yeah, it is an extreme example, right?
I have a question.
Yes, please.
Yeah, I want to ask, like, the investment bank sell at 160.
No.
Offer
Yeah, this is important to understand. When we say that the IPO is priced at $68, it means that the investment bank is committing to buy the shares at that price and sell to investors also at that price. The investment bank is not making money on that transaction. Then investment bank charges a fraction of the, it earns a commission on this trade, which is, it's large, right? Because it is $3.5 billion deal, so the investment bank can earn money on that.
But where is the extra of the gain? Where it goes?
Yeah, and then the investment bank sells these shares to investors, right, who get the shares of the IPO. Yeah. So these 51 million shares goes to the investors that the investment bank allocates shares to these investors, and then they make money. The investors who get these shares are the ones who are seeing a very high appreciation of the value, right?
So it means that it's only the market price is 100 something, but the person who bought is only 68. So they
Okay. So if you get shares, the bottom line is, if you get shares in an IPO, you're likely to make a lot of money. And this is right. This is an extreme example. But if you look at the data, this is data that you can easily collect because it's easy to get data on the IPO price, and then of course you can get data on the first, the opening stock price or the stock price after 1 day, 2, 3 days, etc. And what the research shows, and here actually is this is a website of a professor in the US who specializes in IPO. So if you're interested in this market and learning more, I think that's probably the best source. His name is Jay Ritter, and he's done, all his career is based on studying IPO. So what the evidence shows, both for the US but also for other countries, is that there is underpricing on average. Okay, so on average, shares are the IPO price. So what this 20% number means is the IPO price is 20% less than the opening stock price. So there is a 20% return on the first day of trading. Okay, similar to Airbnb, but it's not, in percentage terms, it's not as much, right? The underpricing in the case of Airbnb is more than 100%. Okay, so it is a very common phenomenon. And then, as you might wonder, right, there is research. This is one of this is probably the key research topic in IPOs, is trying to explain and understand underpricing, right? Why is there underpricing? And there are two theories, and one of them is more, one of the theory, I want to say good and bad, but it's kind of what it is. So there is a theory that is based on conflict of interest. So it's kind of the bad side of IPOs. So let me start with that first. So some people believe that the reason why investment banks are underpricing shares is to benefit the investor, right? So the investment bank has a set of preferred clients, right, that they make deals with. It could be wealthy individuals, for example, who have a lot of money invested with the investment bank, and then the investment bank underprices shares to benefit the investors and to gain more business. Okay, so that's the bad theory. It's the bad side of IPOs, and sort of an agency story, right? That you probably talked about agency problems in your other courses. But then there is also a theory that is based on asymmetric information. Okay? It's kind of similar to that's where it's similar to the SEO case that we're talking about, right? So here the explanation is that the investment bank may be concerned with the possibility of overvaluing the share, right? So charging, you never know what the right value is. This $68 has to be determined in a spreadsheet. I mean, maybe you can write a more complex, maybe you can use Python or something, but it doesn't matter. It's a financial model, right? So it's a spreadsheet that tells $68. Who knows, right? There is, it's possible that you overvalue the share. Okay, so and then the other, but just overvaluation doesn't explain underpricing. Then the other side of the argument here is that there may be investors with different information, okay, and if the bank prices the shares at a too high value, you end up attracting investors that you end up attracting the wrong investors. So then the way that the bank solves this problem is by lowering the price. Okay, so it's kind of a similar story to what we saw on IPOs, and and this of course is kind of a good explanation, because it's not because of conflict of interest, because the investment bank is trying to solve market friction. Okay, and then there is some the interesting feature of the IPO market is that of course companies have try to overcome this problem, right? So one example is Google. So Google actually went public in 2004, so it's not that, Google, of course, one of the most valuable companies in the world now. They went public not that long ago, and when Google went public, they actually decided that they were not going to hire investment banks. And if you read about the Google IPO, the reason why the founders, the explanation that the founders gave is that they were not happy with the way that investment banks were conducting IPOs, because they thought there was a conflict of interest, and the investment banks were making money at the expense of the companies, right? So Google decided to do an IPO using an auction instead of the usual underwriting process. Okay? And then there's no investment bank. They hired people to help with the valuation. That could have been an investment bank, right, to kind of verify the valuation that they did, etc. And then they decided to price the shares at $85, and then the shares were auctioned in the market. So anyone could place a bid, right? And we're not going to talk about details of auction theory, etc. But just the bottom line is that Google still had underpricing. Okay, so if you look at the data, what happened in the first day of trading, Google stock rose almost 20%. Okay, so that's kind of the average amount of underpricing that you see in that you see in the data. And if you think about this case, so here there is no investment bank, right? And you still have underpricing. So, for whatever reason, it seems that underpricing is a feature of the IPO market that is not that easy to get rid of, right? So just getting rid of the investment bank is not going to eliminate the underpricing. Okay? And then now there is I was checking. I wasn't sure I had included this, but I can talk about it a bit. Now there is a new way of doing IPOs, which I don't know if you heard about in the US. It's called the Special Purpose Acquisition Vehicle, SPACs. This is a hot new feature in financial market. So a SPAC is another attempt to do an IPO using a different structure. So a SPAC is a combination of a merger and an IPO. So you create a company that is almost like a shell company that has cash, and then the shell company buys the target that wants to become public. So the shell company is public, and then it buys the target at a certain price, and then brings the target to the public market. So that's what the SPAC is, and then one of the rationales for the SPAC is to try to eliminate or to mitigate this IPO underpricing that we talked about here. It's not clear yet whether there is no final verdict on the SPACs, but that's kind of, you can also relate it to this underpricing story. Okay, but anyway, so the most important thing to take away from this is that these are two other examples, right, of situations in which companies issue equity. Again, in the case of a venture capital startup, it's because that's probably the optimal, right? So it's not because you don't have another option like in the mergers, right, to mitigate leverage, but here it is probably because it's optimal, right? And then you have IPOs, which is an important. So it's unavoidable, right, that you have to issue equity if a company wants to become public. Okay. So any question on this? Any question on this? Okay, so let's go a little bit more because it's only 1 hour. So, and we'll do the break. We'll do the break soon. Okay. Our next topic is payout, right? So yesterday we already talked a lot about payout in the context of private equity deals, etc., and mergers, It is an important topic. It is an important corporate financing decision as well, and it's worth its own discussion, right? So think about the question here. You can think of it as the mirror image, right, of issuing cash. Of getting cash, right? So companies issue securities to raise cash, right? That's a very important part of corporate financing, what we've been talking about, issuing debt or equity, what type of debt, what features the debt has, what's the cost of issuing, those are all issues that are linked to issuing securities to get cash. And now, what payout really is the decision to return cash to investors, right? So that's why this is sort of the mirror image, and the main ways in which companies return cash to investors is using dividends and repurchase, right? So, and if you think about debt, and here it's more related to equity, right? Because in the case of debt, debt investors are also getting cash back, right? But it's not really a voluntary. It's not a decision. The interest payment is a feature of the contract, right? So the company doesn't have to determine how much interest, this is determined initially in the contract. So it's not really a residual, it's not really a decision, a corporate finance decision, okay? It's not a policy, right, if you think of it this way. But companies do have to decide when to return cash to investors and how much, okay? And this is dividends and repurchase. And it's good to start as we did yesterday, right? And with many, as with many topics in corporate finance, it's always good to start with the Modigliani and Miller benchmark, right? So that's what we're doing here. And we can actually start with the dilution story that we talked about yesterday, right? Think about stock repurchase is a situation in which the company is going to buy back shares from investors, right? Buying back shares from investors is going to cause the number of shares outstanding is going to decrease, right? That's a mechanical effect. So it's a common argument, if you open the financial press, people talking about repurchases, etc. A common story is that the stock repurchase reduced the number of shares outstanding, right? And that's why the stock price goes up, right? So it's related to what we talked about yesterday, right? The stock price is equity value divided by the number of shares outstanding. So when you repurchase shares, the stock price goes up, right? What's wrong with this argument? Why is this wrong? There's two effects, right? The number of shares outstanding goes down, but what's the other effect? The company has to spend cash, right? So it's the same calculation, that's the same calculations that we did yesterday, okay? And I'm going to show you some examples in a second, but if, if dilution is an illusion, then eliminating dilution or reducing dilution is also an illusion, right? So it works both ways. It's the mirror image idea, right? So the number of shares outstanding really doesn't matter in a fundamental way, okay? So here is a numerical example of this idea, right? Similar to what we did yesterday, but now we're going to do a repurchase instead of issuance, right? So suppose that you have a company that has a stock price of $80 a share, and that's the market price, right? And has 1,000 shares outstanding, so or a million, or a billion, I don't know, it can be whatever. The math is not really affected by the unit, right? So let's say it's million. So you have an equity value of $80 million, okay? What happens to the stock price if the company decides to repurchase 100 shares, right? We can do the calculation similar to what we did yesterday, right? So there is, right? The first effect is that the number of shares outstanding goes down. And that's the dilution story, right? So, you say, okay, the value is 80 million. Now we're dividing 80 million by 900, so the stock price is going to go up. But the problem is that, you have the other effect, right? So the new stock price has to take into account the fact that the company spent cash to buy back the shares, right? And here, as we did yesterday, you can calculate the amount of cash that the company spent, right? And in this case, it's 8 million, right? Because you're buying 100 shares at $80, right? So I hope I get the units right here, but you can see the idea, right? And if you do the calculation like that, the new stock price is $80. Okay? So the stock price doesn't change if when a company does a stock, if the company buys back the shares at the market price, then the stock price should not change, right? The NPV is 0. It's the same, right? And if you remember what we talked about yesterday, one of the key principles of market efficiency, of efficient markets, is that the net present value of purely financial decisions, such as stock repurchase is an example of that, right? The NPV should always be 0. Okay? So that's another example. And it's similar to what we did yesterday, the idea, right? So what matters is if the company buys the shares at market price or not, right? So if the company can buy back the shares at a price that is lower than the market price, then the NPV would be, right? In this case, would the NPV be positive or negative for the company? If you buy the shares at lower than the market price, then the NPV is positive, right? If you buy back the shares at a little higher than the market price, the NPV is negative. Okay? So it's very similar to yesterday, but with the signs reversed, right? Now what about dividends? Okay? So suppose a company decides to double the amount of dividends that you're paying to investors. What should be the NPV? So you have a company, let's say PepsiCo, whatever, right? It's paying a certain dividend and now it's going to double the dividend. What should be the NPV? 0, right? That's always the answer, and we can give an example here of why this is the case. So this is PepsiCo, right? And using the same data we were talking about yesterday during 2015. So you can check in the cash flow statement of a public company. You're going to find data on both stock repurchases and buybacks. So in the case of PepsiCo, for example, they repurchased $5 billion. This is in billions now, right? This is a large company. So they repurchased $5 billion in 2015, and they paid $4 billion in dividends. Okay? So again, and by the way, PepsiCo is an example of what we were talking about yesterday. If you get data on U.S. companies and you calculate the amount of repurchase and the amount of issuance, then what you see is companies repurchase a lot more shares than they are issuing. Okay, so you can see here PepsiCo, every year, right, the company is repurchasing billions of dollars in shares. Okay, so $3 billion in 2013, $5 billion in 2014, and $5 billion in 2015. And then, of course, there is some issuance as well. Some of these issuances, it doesn't have to be SEOs. For example, it can be due to executive compensation. So you issue shares to pay the CEO, etc., and this is going to be counted here as well. But you can see that the company is on a net basis, PepsiCo is repurchasing a lot of shares. Okay, but then it also pays dividends, and the dividend is going to show up in the cash flow statement as well, right? So you can see here that PepsiCo paid it's paying kind of a regular dividend, right? 3.4 in 2013, 3.7 in 2014, and then $4 billion in 2015. Okay? So what happens if PepsiCo decides to double annual dividends to $8 billion, right? So what would happen is, of course, shareholders would get more cash, right? So instead of getting $4 billion, so if each shareholder is getting $2 a share, for example, in dividends, now you're going to get $4, right? But then the problem is that you're paying investors a higher dividend, they're getting cash, but the cash is coming from the company, right? So the cash is going to reduce. If you go back to the cash flow statement, the cash is going to reduce the amount of cash that the company has, right? And who owns the cash that the company? The shareholders also own the cash that is in the company. So paying a dividend, really is like moving cash from one pocket to another, right? So shareholders own the cash, irrespective if it's in the company or if it's outside of the company, right? Or at least in a perfect world, it shouldn't really matter if the cash is in the company or if the cash is in the pocket of investors. Investors can access the cash anyway, right? Okay, so that's why it really shouldn't matter whether companies, how much dividends companies pay should really not affect the stock price. Okay, so this is a version of Modigliani and Miller for payout, and really it works as we discussed it yesterday. this works for any type of financial decision, right? Issuing equity, issuing debt, paying dividends, repurchase, risk management that we're going to talk about later. Everything should be zero NPV if we live in a perfect world. Okay? But then, of course, this wouldn't be a very interesting class, right? This is not how the real world works. Okay? The real world works in a more interesting way, and that's what we're going to talk about. I think we can do the break now. This is a good spot to break. So we're going to talk about what happens in the real world and then try to explain why and think about payout. Okay, so let's take a break now. So 15 minutes, right? That's all. Yeah.
Definitely. neanche oggi le slide non ci sono.
Neanche oggi le slide arrivano domani.
A questo punto lunedì. Come è andato l'esame?
Io?
Disarta?
Bene.
Bene?
Sì. Non ho finito ma pensavo sono troppo peggio, ma non è troppo.
Meno male. Tu invece Tan?
Bene rispetto a che pensavo io, ma solo che ieri avete visto che Corina ha mandato quella foto, come si calcola quello? Se non sbaglio alla fine magari 27,42, manca 003, 008 di arrivare, di prendere la lunga, quello lì. Porca miseria, scusatemi.
Ma così ti pensi molto, non senti.
È difficile, no, anche perché, cioè, nel senso, io ho provato a fare la proporzione, però io non l'ho fatta come l'ha fatto Nelly, cioè io ho prima trasformato in trentesimi e poi ho fatto la media.
Invece no,
In realtà loro fanno il contrario
devi fare prima
e
il
non so se
centesimo.
venga uguale.
Viene più o meno uguale,
Sì,
cambia
sì.
qualche centesimo.
Ma solo che prof Busso non può darci 3,93 invece di 92,5.
Sì, infatti quella cosa mi cioè, ma detto, che cazzo mi dai 92 e mezzo? Dai,
Mezzo,
ho 92,
esatto.
93, cioè che
Sì,
cazzo vuol
ma-
dire 92 e mezzo?
Sì,
Quello
Cioè,
mezzo veramente-
non ha senso, infatti ma anche secondo me non ha senso.
Sì.
Cioè che cosa me ne faccio in 92 e mezzo?
Esatto.
Niente.
Questo 0,5 o mi togli e così magari
sì, o
prendo.
mi togli o mi metti.
Esatto.
Ma magari poi fanno degli arrotondamenti, dai.
Non penso questo di 92,5 ci fa quello, Già che dicono quelle
Cioè
due.
già è difficile fare questa proporzione, poi lo vengono 92 e mezzo, cioè tipo fa normale questa cosa di proporzione.
Mamma mia.
Ma poi mettimi il voto in trentesimi fin da subito e bomba.
No,
Io so che voto ho.
complichiamo la cosa, dai, facciamolo diviso per 4 perché poi alla fine sono 4 voti in realtà.
Sì.
In centesimi non
Solo
in
che
prende.
2 valgono il 60%
E l'altro
due valgono il
40, e poi 50 più
che
50 di
cavolo,
nuovo.
cioè.
No, prima fai in centesimi e poi dopo trasformi in
30.
centesimi.
Tu Claudia come la sei fatta?
No, è andata bene, bene.
Poi solo la prima.
Non lo so, alla fine mi esce 25 come percentuale. Alla fine sì, infatti non lo so, non so se
Come
fare.
l'esame?
Applicati?
Io
No,
ero-
no,
è un tuo calcolo.
no, sono
È un calcolo nostro.
Sì, ma io avevo già immaginato che li calcolassero così.
Sì.
Che non arrotondassero prima, intendo,
Sì,
ovviamente.
sì.
L'arrotondamento
Arrotondano poi
solo.
alla fine col centesimi.
Siete soddisfatte? Ridate qualcosa?
Io sono indecisa se ridare la prima parte.
Ah sì, no, decidere per la prima.
Sì.
Sì, perché a gennaio potresti ancora dare solo una delle parti se vuoi.
Ma io pensavo che dopo 5 giorni
No,
che
no,
tutto
ma
il
non c'è
voto,
ancora sta cosa
non
perché
No.
sono un po'.
No, perché non sai, magari va bene una, l'altra non ti va tanto bene, quindi vuoi ridare un'altra.
Ma che figata, non lo sapevo.
Sì, fino a.
Non lo so.
Penso fino a quando uscirai molto sul libretto, cioè sulla bacheca editi, magari avrai 5 giorni per decidere se accettare o rifiutare, in quel caso magari una parte, più, non so.
Sì.
Sì.
Bravo. Non avresti potuto dirlo a me.
Sono indecisa.
Io anche sono indecisa per la prima parte.
Quanto è presa la
Anch'io
prima
per la
parte?
prima.
Perché avevo fatto, vabbè, 69 e quindi però vabbè, era un periodo che non ero ancora abituata al metodo e tutto quanto, allora.
dato un messaggio, ma non ho capito che bene cosa
Aspetta. Cosa ho scritto?
Guardate.
Ah,
Poverina, lei segue da...
Online.
Ah, oddio!
Sì.
no, era Francesca.
Francesca, di nome è Francesca, non è Claudia.
E quindi sì, non so cosa fare, se ridare solo la prima parte. Infatti ci sto pensando.
Ma il secondo quanto preso?
Vabbè, in totale poi mi esce 25 tra tutto quanto. Infatti per quello volevo vedere un attimo com'era
Sì, faccio dei calcoli.
Fate dei calcoli e valuta quanto ti servirebbe per arrivare, che ne so, 25.500
Esatto.
già costa 26 e se ci puoi arrivare a studiare.
Perché magari non ci
Non
arrivi,
c'è.
cioè, capito? Magari devi veramente prendere un moto alto,
Molto
alto,
più
secondo me,
alto.
tipo sopra il 95 per alzarlo di un certo livello, se no... Infatti anche io ci ho pensato, però secondo me è tempo
Anch'io che l'ho
perso.
pensato.
È tempo
ieri.
perso perché o prendi veramente...
Altissima.
esatto.
Ma è una cosa.
Cioè, esatto,
non puoi
sbagliare
sapere.
niente.
Banana? È finito?
Finito.
Oggi barrettino.
Un po' visto la banana, però.
Cominci sempre dalla B. Va bene, bene.
Mando che noci.
Mandorle. No, comunque non pensavo lo sentisse. Pensavo pure parlando al microfono e sentisse la casa.
Ma così non
L'altra volta no, è vero, non si sentiva,
No.
perché poi eravamo fatto. Avevo fatto gli
Perché di là?
spostamenti.
Esatto.
E vabbè, dai.
Cazzo,
Non abbiamo capito che si sente un bel qua.
Voi avete fatto il gruppo insieme? E che cosa avevate?
Erg.
Com'è andata?
Prima parte.
La parte male.
Anche no, io mai, non
La seconda
sappiamo
parte
neanche
meglio.
perché però.
La prima parte male. Infatti...
hanno proprio.
Solo che purtroppo non si può cambiare.
No,
Perché sennò se avessi avuto un punto un po' più alto di quello, non farei problemi, oddio, se prendo un voto,
che poi non danno tempo quelli.
Poi non danno spiegazioni.
Appunto.
E infatti non sappiamo cosa non è andato.
Sì,
Cioè che
non so come fare il ricevimento infatti.
Avete preso 100, lavoro di
Mettiamo
gruppo.
il
non
nostro
puoi migliorare
logo
niente.
sul schermo.
Brava, che cosa avevi? Che cosa avevi di azienda?
Standard, cioè.
Sì, standard.
Mi sembra delle macchine, normali, no?
Sì, automobile.
Sì, automobile.
Scusa, non ho sentito bene. Sì, dai.
Sì, infatti, chissà che cosa possiamo migliorare magari per la seconda parte, ma nessuno ti dice niente, quindi dici va bene, ok.
Ma la seconda parte è un po' strana perché quando abbiamo parlato l'approccio ha fatto notare errori, capito? Ho detto tipo adesso quindi il tempo è andato più veloce, nonostante tantissimi
No,
altri stavano
tutti.
sforando, ci siamo messi malissimo. E in realtà poi come voto è andata meglio rispetto alla prima in cui non
Ma
avevo
penso
niente
tutti,
da
perché
buttare.
erano tutti più alti.
Sì.
Abbiamo fatto un vagone. Oh no, non lo studio.
Ma
Come
come
a parte gli
a parte
indici.
tutti gli indici a trovarti i dati era un casino.
La seconda parte è
Stavo
davvero
mandando un
pesante.
audio.
Mamma mia, non posso immaginare.
Mamma mia.
Davvero.
Non si lasciare.
Mm?
Ma
Cola?
che avviso, già più fame, quindi
Cola?
non hanno
Cola. 宝贝，你刚才的回忆还是在脑海里的。
Adesso non so.
Devo rompere me.
Non me l'ho salvato perché mi mancano no, era una domanda mia.
Okay, yeah.
哪个？我们的助教还是王健？2选1。
2选1啊，王嘉尔。对不起。算了，还是小阿尔贝多。
啊？
还是阿尔贝多。
Really?
Comunque Bombo Freddo scende senza niente, però.
Sì. Bentornato. Oh my god.下次带个巧克力。
对，我昨天想买巧克力，但超市的那些都不是
特别
一整个的那种。
对。
我去 Vanky 去买点散装。
那我觉得今天Francesca 做的特别好，一个锡纸包，一个小一块，你自己掰好。
聪明。
And then we can switch back to the slides. Yeah, it's just good. They asked me to cover something. I have to give
不是带了吗？吃的，一定要吃。
Okay, so let's get started again. So I was asked to talk again about why is it that increasing a dividend doesn't change the stock price, right? It was moving cash from one pocket to another. So that's one way I like to think about it is that, is that the shareholders own the cash no matter what. But we can actually do it. I think what might help understand this is if we do a numerical example. You're going to see it's similar to the stock repurchase, but it may be more clear if I put some numbers down. So that's why I asked Nico to tell me how can I write in a way that the people online can see. So I have it down now. So I'm going to sit down and write an example here. Okay? Try to make this work. Okay, so we don't have to use exactly the same number, but let's do it like that. So let's say we have a company that has. Can you move the paper, please? Or what's happening? Yeah, right. Now can you see it now? Yeah, now it's okay. Yeah, let me know if you can't see, okay? This is not trivial. It's harder than finance. So let's say the equity value is 60, okay? And let's say there is 10, it could be millions, whatever, right? So if the equity value is 60 million and there are 10 million shares outstanding, what's the stock price?
6.
6. Okay? So let's say that and the numbers really don't matter. There's probably going to be a dividend that looks too high, but just to make the numbers easy, let's say that this company was paying a dividend, or no, let's make it easy. Let's say that the company is not paying dividends at all. Okay? So there is 0 dividend. Right? And now, okay, so that's the initial situation. My hand shows better than the right. So this is before. Yeah, you always learn something new. This is the first time I'm doing this. Before, right? And after. Okay? So now let's say that the company pays a dividend of $1 a share. Okay? So now, right, each shareholder is getting $1 in dividends. Right? So why is it that, it seems that this is a good thing, right? They're getting cash. Okay? Why is the NPV 0? Let's try to put it in numbers. Okay? So this is going to be very similar to the idea of the stock repurchase. Right? First, let's start with the easy one. When you pay a dividend, do the shares outstanding change? No. Right? So what's going to happen to the other two numbers? Let's think about that.
It will be decreased.
Yeah, right? So it's very similar to the stock repurchase. If the company could come up with cash from the air, that would be positive NPV. But to pay a dividend, what needs to happen? Yes, right? The company has to either fund the dividend with cash, right? Or if the company doesn't have cash, what does the company need? What does the company need to do to pay the dividend? Issue debt, right? Either way, either if you issue debt or if you use cash, the equity value is going to decrease, right? So what is the new equity value? Can we calculate it here? Yeah, right? What's the equity value? 50. So what's the stock price? 5. Oh, but the stock price decreased. Isn't this bad? It's the same, right? I mean, this is what I meant by moving cash from one pocket to the other. Okay? Everybody, let me make sure everybody understands. So the stock price decreases. Why does the stock price decrease? Because the company paid a dividend to the shareholders. Right? So the shareholders have the cash in their pocket. There is less cash in the company. So the stock price goes down. Do the shareholders care? No. Right? The shareholders don't care because they got that dollar. Right? So, like the stock price, you can think of the stock price here as one pocket, right? And the dividend is the other pocket. You're just moving cash, right? Did you see that? Yeah. You're moving cash from one pocket to the other. Okay? Actually, yes. Question?
But MPV, isn't that related to the stock price?
Yeah, but sometimes you have to make adjustments, right? I mean, there is a, in finance, the way we handle this, for example, when you get data, okay, on companies, the stock returns are typically adjusted for dividends. Okay, so obviously, if you calculate stock, I mean, this is an extreme example because a dividend of $1 a share for a company that has a stock price of 6 is very large. Okay, but if you calculate a stock return here, let's do it. Well, I'm almost out of space. Right? If you calculate stock returns, it looks as if, right? So if we just use the stock prices, the actual stock prices, right? It looks like you have a negative return, right? Because it's the stock return is what? 5 minus 6 divided by 6, right? So how much is that in percentage? Is this 16%? I don't know. 1 divided by 6 is what? Minus 1 divided by 6, right? Minus 7, 6. Yeah, I don't know. Can you do the calculation for me, please? I can do that in my brain.
0.
Yeah, that's what I thought. 16.67%, right? Okay? So it's a negative return, and if you just get data like that, it would look like this is negative NPV, right? So what we need to do to get, the right answer is that the stock return should be, what should be the stock return after you pay the dividend? 0, right? Because the shareholder doesn't care. So, 0, it has to be 0 NPV, so the shareholder didn't gain anything, didn't lose anything, right? So what we do in finance, when you get data in stock returns, for example, is the stock return data is adjusted for dividends. Okay? So that means that you are adjusting, so when a company pays a dividend, that is counted towards the stock return. So instead of doing minus, so the way you calculate the stock return, let me do it here, adjusted for dividends. Okay? The way that you calculate the stock return is by adding the dividends. So, it's 5. Oh, now you can't see it, right? Okay, it's 5 plus 1. So this is the stock price. This is the dividend that you paid. Okay? Minus 6, that was the stock price before. So now we get a 0. Okay? So we are adjusting the stock return for dividends or the stock price. So the stock price, even when you get data, when you see data on stock prices for companies that pay dividend, what you're going to see is the 0 and not the minus 16.67%. Any question here? Please, yeah. If you have questions, okay? So that may be a better way of showing why does you get 0 NPV. Okay? Any question?
So MPV means price and dividend.
Yeah, yes. The NPV, you can think about it this way. The NPV is 0 when the stock price doesn't change. Okay? But here the problem is if you don't adjust the stock price for dividends, it looks like the stock price is going down. Right? So what you need to do is you need to adjust the stock price for dividends. Okay? And that's how the data is reported. So, of course you can get data if you go to a standard database where you get stock returns, you can get adjusted returns or unadjusted returns. But any, for example, you might have covered the capital asset pricing model, right? When we use stock returns to calculate beta, what we use is the adjusted return. right? Because it seems wrong to use the unadjusted, right? Okay, so all the return, and this is very, of course, you wouldn't get minus 17% for a real world company because the dividend is not that large, right? Dividends per share are usually not such a large fraction. This is 1/6, right? So it's like the dividend is a very large fraction of the stock price. Okay, in a real world example, the adjustment would be smaller, but it's important to do. If you don't do the adjustment, it would be misleading. You would have misleading data. Okay, this is clear, everybody. All right, good. I hope that people online saw it as well. Nico, can you help me out here? Now I have to go back. But it's not Nico, it's not showing here, sorry. Just a second, we're trying to get the slides back up. Fortunately, I have help. Great. Okay, so very similar to what we did yesterday, right? The Modigliani and Miller arguments, efficient, perfect markets, no frictions, right? Seems to suggest that the dividend, for example, is irrelevant, right? You pay a dividend, like we did in our numerical example, you move cash from one pocket to the other. The stock price goes down, but it doesn't really matter because the investors get cash in exchange for that. Okay? Or a stock repurchase, right? Reducing the number of shares outstanding doesn't matter because to reduce the number of shares outstanding, you have to spend cash. And if you do the math, it suggests that one effect exactly cancels the other one out, and we get the same. In the case of repurchase, we should get the same stock price, right? But that's the theory, right? And fortunately, because otherwise finance wouldn't be very interesting, right? It's always important to start with Modigliani and Miller, but then we need to see what actually happens in the real world, right? And you might have seen this evidence before, you might know the answer to this, right? What happens in the real world, what happens when companies increase dividends or when companies do a stock repurchase? The stock price, does it go up or down? I mean, in the case of dividends, it's important to adjust the price, right? The stock price would go down mechanically, but the adjusted stock price, right? The adjusted stock return, is it up or down?
Same.
Same? No. It's actually up. Okay, yeah, it would seem that it's zero based on the theory, okay, but the real world doesn't work like that. Okay? So investors seem to respond positively to stock repurchase and to increase the dividend. So investors like when companies pay dividends. Okay? And they like it when companies do stock repurchase. So that's what we see in the data. There are lots of studies on this, and these are essentially event studies that we talked about yesterday, right? So the way you do this is, I have it written down, but the way you would do this is you would look at the announcement date, right? And rather than looking at the date that the company pays dividend, what you need to do is you need to look at the announcement date. So the way that it happens is companies will announce in advance, right? They don't pay a dividend by surprise. They announce in advance the dividend that they expect to pay. Either a regular dividend, or in some cases, companies pay what's called a special dividend. So you pay a one-time dividend to investors, right? So in the case of this article by Jalase, Michaeli, and Taylor, okay, they're looking at instances in which companies announce a large increase in dividends, okay, and also when companies announce that they need to decrease dividends, okay, and this is the announcement date. So that effect we worried about in our example doesn't matter because the dividend wasn't paid yet, right? So you're just looking at how stock prices change. When you announce, you don't have to take the actual dividend into account yet. Everybody understand that? So it's the announcement. That's the other advantage of doing the announcement. And what happens is they find that stock prices increase by 1.32% when companies announce a large increase in dividends. And they decrease by 2.5% when companies announce that dividends are going to decrease. Okay, so investors take dividends is essentially a positive. Investors see dividends in a positive way. Okay. And then there is another paper by Michaeli as well and Taylor. And this is the same Taylor who won the Nobel Prize for Behavioral Economics. So, he's done some finance research that is non-behavioral also. You can also look at when the first time that a company pays a dividend, right? So many companies are like the example I gave you. They don't pay any dividends, right? But then they announce that, now we're going to start paying a dividend, right? And in that case, the reaction is actually even larger. And then you can also look at the reaction to the opposite case, when a company omits paying a dividend. So you tell investors that, we're not going to be able to pay our dividend. So we're cutting it to zero. And in that case, the reaction is -7%. So this 3 days is a standard window to look to the announcement return. So rather than just looking at 1 day, you have a slightly wider window around the announcement. But all of these articles, when you write, you have to do some robustness, so look at 1 day return, weekly, and so the findings are very stable. Okay? And this evidence hasn't really changed over the years. These are very older papers. But the reason why there isn't a newer paper is because there's nothing new to report. The results are still there. I actually checked it with and sometimes it's interesting because we kind of assume that the result is there, but it's good to check once in a while, right? I actually checked it for stock repurchase to see if there was anything new, but there's pretty much the same. So this is actually from some data that I collected myself. For repurchase announcements. So now what we have here is a situation in which rather than a dividend, okay, now the companies are announcing a stock repurchase. They are announcing that they're going to buy back shares, okay? And again, we're looking at the announcement date. We're not looking at the actual repurchase date. And it turns out that in the US, you actually cannot measure the actual repurchase date because companies repurchase shares in the open market and they don't have to report that they are buying shares on, let's say, what's the date? Friday, November 19th. Okay. Without my glasses, I can read. Okay. So companies don't have to report that they are buying shares today. but they have to announce to investors that they're going to repurchase a certain amount, and that's the date in which we measure these events. Okay? So this is the number of events for each year. I did this for more recent data, just to see, the studies in the literature use the older data. So I said, let me check to see, maybe something changed. But no, actually the reaction is very similar to what the other studies have measured. It's and you can see it's also fairly stable over the years. And the only thing that changes is the number. So 2009, right? It was the year right after the financial crisis, and that was the year that companies were more cash constrained. You see that there are fewer repurchase announcements on that year, okay? But and then when there is an announcement, the return is actually larger, right? But it's fairly stable over the years, and what you find is that the repurchase announcement on average increases the stock prices as well, okay? So both dividends and repurchase are taken as positive signal by investors. Okay? And now what we need to talk about is, of course, why, right? What are the financial theories that can explain the positive reaction to dividends and repurchase, right? And that's exactly our topic, okay? And this discussion is going to help us in two ways. Not only explain the evidence of why investors like stock prices, but if we understand why investors of course like stock prices, right? Why investors like payout, right? If we understand why investors pay out, we are also understanding the factors that are driving payout policy, right? Because those are the underlying reasons why firms pay out. I mean, it's not finance. Finance academics will not be satisfied just with an argument saying that, we pay repurchase because it increases the stock price, right? We have to understand why the repurchase is increasing the stock price. Okay? And similarly for dividends. And there are four main arguments in the literature, in the history of these studies about payout policies. There are four main arguments for why dividends matter. Turns out that taxes doesn't work. It's actually not going to explain anything, but it's an important discussion to have as well. Okay, the main reasons are signaling cash management. Those are going to be arguments that work for both dividends and repurchase, and then we're going to talk about earnings management as well, which is more related to stock repurchase. Okay, so let's start talking about taxes. And in this case, taxes matter because investors will typically owe taxes when a company pays dividend. So going back to the example I was doing there in the board, it's not true that investors will necessarily get $1 when a company pays a dividend of $1, because the dividends are taxable. And the taxation of dividends, of course, depends on the specifics of each country, right? So, it depends. In the US and in many places, dividends are taxed at the personal income tax rate. So that was the case in the past. Now, though, in the US, dividends have a special tax. So it's taxed as personal income, but there is a special dividend tax. Okay, so what investors do is when they file their tax returns, they have to report how many dividends they received on that year, and then the dividends are going to be taxed at a certain rate. It turns out that the rate is slightly lower than what you would pay on your marginal. If you're a wealthy investor, the dividend tax is lower than, it's 15 or 20% in the US, the dividend tax. Okay? But anyway, the important point is that investors are not going to get the full dollar, right? Or in the case of PepsiCo, investors are not going to get. PepsiCo is paying $4 billion in dividends, but 800 million, if the tax rate is 20%, let's say that's the full dividend tax, then investors are only getting 3.2. Okay? And taxes are, of course, very complicated. This is easy to understand the basic idea. In reality, the amount of taxes that investors pay also depend on other factors. So, for example, if investors hold the stock in a pension fund, right? Then, and it's a pension fund that it's like a retirement plan, which is a very common way that investors hold shares, right? Then the dividend is not taxable. What happens is you can reinvest the dividend. If you reinvest the dividend in your retirement plan, then you don't have to pay tax. Okay? So it depends on many factors, and there can be special breaks, etc. But on average, the tax is not zero. It may not be the full 20%, but it's going to be positive. So some money is disappearing. Right? Okay? In terms of repurchase, it gets even more complicated because now we really need to do, if we have to calculate the actual tax that investors are paying on a specific repurchase by a company, then we have to get a lot more data because stock repurchase is like selling shares, right? Investors who sell shares back to the company, they are selling shares at a certain price. So now this is not an income tax anymore. This is what we call, this is a capital gains tax. Okay, so investors are going to be taxed if they have made a taxable gain. So then what you need to do, this is the US, again, this is based on US taxation rules, and it could differ across countries, but my understanding is that this is roughly the way that repurchases are taxed in different places. So the taxable gain would be the amount that the investor got for the shares, right? Minus what's called the cost basis. So the cost basis here is the price that investors paid for the shares. So then of course it gets complicated because investors might have bought the shares at different prices, so there's tax rules to figure all that out. But there is potentially a taxable gain, okay? And the capital gains tax in the US right now is also 20%, the maximum capital gains tax. So you can see it's pretty similar for dividends and stock repurchase. So, right, the bottom line of the tax discussion is, how much taxes, right, would investors have paid? Suppose PepsiCo had done zero payout. How much taxes would investors have paid? Nothing, right? Okay, so we can do the calculations here. Let's go over the numbers with you. Okay, so here you have for 2015, and we could have used any example. There's nothing special about PepsiCo, right? So the company had paid $4 billion in dividends. Okay, so that, let's say if the tax rate is 20%, then investors got the after tax. The after tax payoff is 3.2 billion. Okay, PepsiCo spent $5 billion in repurchase, so investors probably have to pay some tax on that as well. I mean, that we don't know. It depends on, right? So if the PepsiCo stock price is going down, maybe investors bought the shares at a higher price. They might even get a tax break. So here it's a little more complicated, but there is potentially a tax. So on average, investors should get less than 5 billion. Okay? If PepsiCo had retained everything, right? So suppose that PepsiCo cuts everything. No, let's keep the money. Then investors would have paid nothing, right? So it's zero tax. Okay? So essentially, payout taxes are not good for payout, right? It's better for investors to leave the money in the company rather than having cash come out all the time, because every time the cash comes out, there is a taxable gain. Okay? And of course, at some point, if the investors want to get cash out of the investment, might have to pay taxes. But then investors can choose when they're going to do it. Right? The dividend is the extreme example. It gives no choice to investors. Anybody who holds shares, if in a taxable account, is getting dividends, you have to pay taxes on that every year or every time you do a tax return. There is absolutely no choice. Right? With the repurchase, there's a little bit more choice. So the bottom line is, taxes are bad for payouts, right? So taxes really don't explain why companies regularly pay out cash. Investors, from the point of view of tax management, investors would be better off if companies were retaining all the cash, and then you allow investors to sell shares. Maybe they sell shares when the stock price has the decrease. If you want to do good tax management, there are ways you can sell shares by minimizing the tax you pay. Okay? So taxes don't help explain why companies pay out. Later on, we're going to talk about taxes do help. There is a differential effect between dividends and repurchase, but we'll talk about that later. Okay? Any question on the tax story? So now let's get at some arguments that have some bite. It's important to understand the tax effect, but they really don't. If you want, you can think of it as a factor that drives payout policy, but it drives payout towards zero. It doesn't really explain why companies pay out. Okay, so let's start thinking about signaling, and let's take PepsiCo as an example. I think having a real world example is going to help us understand this now. Right? So here is PepsiCo, right? They have cash flow and repurchase, etc. They are paying $4 billion in dividends. Okay? So let's go back to our thought experiment before, right? So suppose that PepsiCo now decides to double the annual dividend. What kind of information does that suggest? The company says that we're going to double the dividend. Yeah, the company believes that we have a lot of cash. We can spare this, right? We don't need to retain this cash, right? We can give this out, okay? So you can see that this is going to there's a signaling effect here, right? Investors react to this because they interpret it as information, right? There is positive information about 2 billion, no, like 4 billion, right? No, I know it. Because the net change in cash, now I got it. If you look at the bottom of the cash flow statement, PepsiCo was generating $2.9 billion in cash in 2015. Okay? So of course, if you increase dividends by 4 billion, now you're going to cause cash to decrease, right? And as we just discussed it, what this means is the CFO of the company must be pretty confident about the company's future ability to generate cash. Because, right, you can't be doubling your dividend if you're going to become cash constrained, right? So paying a dividend gives a positive signal about the company's prospects. Should be, right? And if you think about the repurchase, it's exactly the same idea, right? Repurchase is also spending cash, okay? So, right? So again, if we could do the same thing for stock repurchase, right? If PepsiCo now announces a new repurchase program, again, you're spending cash, you're reducing cash, so that is information that investors are that the company is pretty confident about its ability to generate cash, right? And in an asymmetric information world, managers are likely to know more about the company than investors, so investors are always inferring information, right, from what companies do. Okay, so that is the signaling the signaling story, and clearly, as I said here, it works both for dividends but also for stock repurchase, right? Does it make sense? Any question on the signaling argument? And here's the other argument, okay? And this one is probably a more interesting story, and it does help explain payout according to the empirical evidence. Okay? So let's go back to our PepsiCo example, right? So suppose that now we reverse the thought process here. So instead of doubling dividends, now we're going to cut everything. Okay? So PepsiCo decides that we're not going to pay dividend anymore, we're not going to do stock repurchase, we're just going to keep the cash, and maybe they say that, oh, this is because of taxes, right? So we don't want the investors to pay tax, so we're going to keep the money in the company, right? So this means now that if you go back to the cash flow statement, right, what's going to happen is cash is going to start accumulating, right? PepsiCo is a profitable company. Every year, right, the company is generating, it's generating, if you look at the cash from operations, the company is generating 10.5 billion from operations. There is some investments, right, etc. But clearly, if you don't do any financing stuff, the cash is accumulating, right? So PepsiCo's cash balances are going to keep going up, right? Why can this be a bad thing? What's the problem of having too much cash? Again, if we are in a Modigliani and Miller world, it shouldn't matter, right? What's the net present value of increasing cash? Cash is financing, right? So it should be zero, right? So the cash is accumulating, but that doesn't really change anything, right? But there is a problem, okay? And there is research on that showing that, when companies start accumulating too much cash, in principle, this really shouldn't matter. But what happens in practice is that, we can think of this story as a story that says that cash burns a hole in the pocket. Okay, so when companies have too much cash, they don't keep it. If companies were keeping cash and making the same investment decisions that they were doing before, right, as we did yesterday, then you're keeping investments constant, and then having more cash shouldn't matter. But what we see in the evidence is that when companies have too much cash, managers are tempted to overspend it. Okay, so it looks like it's a cheap source of financing for companies, and what the evidence suggests is that managers are likely to waste it in bad investments. And the way that the researchers have measured this is by using mergers and acquisitions. The advantage of mergers and acquisitions is twofold, right? So as we discussed it yesterday, merger and acquisition investments are very large, right? So they have a potentially large effect on stock prices. And you can measure when they happen, right? So sometimes for company projects, PepsiCo is building a new factory or developing a new soda, right? We don't really know when, there's no announcement date. Okay? So M&A has this advantage that you can precisely measure with some caveats, like, there may be anticipation, etc., but you can more precisely measure the date when the market learns about an M&A deal, right? And then what you can do is you can do an event study looking at what happens to the acquired stock return. And there is this very interesting paper, very famous paper by Jared Harford, showing that basically comparing different acquirers that are short of cash with acquirers that have a lot of cash. And what you find is that when acquirers have a lot of cash, they do bad acquisitions. So the acquisitions on average reduce the acquired stock price. Okay, so the market doesn't like the acquisitions that companies do when they have too much cash. Okay, so that is perhaps indirect evidence, right, that companies are wasting cash. And Harvard actually estimates the amount of value that cash-rich acquirers destroy, and his estimate is that it's 7 cents of value for each dollar, each excess dollar that company, each dollar of excess cash that companies hold. Okay, so cash burns a hole in the pocket, and now we can think about payout as a way of managing this, right? So how does PepsiCo manage this agency problem? You know, you manage this problem by making sure that the company does not retain too much cash, right? So the trick of payout is to only retain the cash that is necessary for operations, right? And that is perhaps for liquidity management reasons as well, but then pay out the remaining, right? Because that's a good way of controlling overspending by companies. Okay, does that make sense? And this argument works both for dividends and repurchase, right? So both dividends and repurchase are getting cash out of the company and helping control this potential agency problem, right? So PepsiCo, for example, is paying $9 billion, you know, basically paying out its entire cash from operations, right? And one explanation for this is that investors wouldn't like if the cash starts accumulating in the company. Okay? Does it make sense? Any question on this? All right. And then so the next set of notes are about the choice, right? So clearly there is some value in paying out cash, right? It could be for signaling purpose, it could be for agency, right, to control overspending, or we like to call this a cash management story, okay? Could be for signaling purpose, it could be for cash management purposes, but the companies still have to choose, right? Are you going to pay using dividends? Are you going to pay using repurchase? How can you make that decision? And here there is an interesting argument which finance academics have pointed out over the years, which is that it turns out that dividend looks highly inefficient. It doesn't seem to be the right way to pay cash, and we'll try to understand why. Okay? And then there is something called the dividend puzzle, which, you know, finance academics actually have a hard time explaining why companies pay dividends, which might seem like a surprising conclusion, but that's going to be the bottom line of our discussion here. Okay? So, you know, just as I said, I think we have pretty solid arguments for payout as a whole, right? But a financial manager also needs to decide how you're going to do it. Right? PepsiCo, for example, is paying out cash using both dividends and repurchase. Right? And maybe let's start with some data. Again, for the US, right? So if you look at changes in payout policy over time, this is what you see. The blue line is the total payout, and this is expressed as a fraction of net income. Okay, it's a typical way to report payout. It doesn't have to be that. It could be as a fraction of assets, for example, but you would see similar effects. But when it's common to report payout as a fraction of earnings, and most companies that pay out have positive earnings, so you don't have a problem of like negative denominators or something like that. So companies that pay out typically have positive and high earnings. Okay, so the blue line is the fraction of net income that is paid out on average for U.S. public companies, and you can see that that blue line has actually remained very stable, right? That's almost like there is some yearly variations there, but it's almost like a flat line, right? So on average, US companies pay between like 20 and 25% of their net income every year. Okay? And then there is an interesting fact, which is that dividends have actually been decreasing over time, right? As a fraction of payout. The red line is dividends, right? And the green line represents share repurchase, again, as a fraction of net income. So both lines sum up to the blue line. And what has happened in the US is that stock repurchase has become a lot more important over the years as a share of payout, and dividends have decreased. So US companies seem to be replacing dividends with stock repurchase, but dividends have not completely disappeared, right? So they are still just as important as stock repurchase. So PepsiCo is actually a representative example, right? They are paying out about the same, amount of dividends and repurchase every year. Okay. So that's what happened over and let's try to understand why might it be the case, right? Why are companies giving preference, increasing the preference for repurchase over time? Okay. And again, we can think about the same arguments that we talked about, starting with taxes. Okay? So, what we learned is that taxes don't really help explain why companies pay out, right? But it does help explain why repurchase might be preferable to dividends, at least in the US. I mean, this conclusion depends a lot on the tax code, of course, right? So, but the advantage of the stock repurchase is not necessarily the tax rate. So in the US, for example, now the statutory tax rate is the same for dividends and repurchase. But the problem of dividends is that investors don't really have a choice. If you hold stock in a taxable account, there's no tax management you can do to avoid paying taxes on dividends. Right? So every time the company pays a dividend, investors are going to have taxable income. On the other hand, with stock repurchase, investors can choose. When a company does a stock repurchase, a company is buying shares in the market. It's just like any trader, right? And then investors are selling. So investors don't necessarily have to participate, right? If you don't want to sell now because you have very high taxable income, you don't really have to participate on the offering, and you can choose not to sell. Okay? So there is a tax advantage argument for repurchase, which helps explain why repurchases are better than dividends. And then there are other arguments, right? So signaling. When we talked about signaling, we focused mostly on the cash story, right? So one potential signal is to signal that you don't need that cash, signal strong future performance, okay? But it turns out that companies can also signal valuation, okay? So let's think about a specific example. Suppose that in a specific company here, the market price is $80 a share, but the management strongly believes that the stock price should be 85. Right? So the managers think that the stock price is undervalued. What can management do to increase the stock price? Yes, right? The repurchase. Think about this case. If the management goes to the market and says, "Look, we're going to repurchase shares at $80," that is a signal that the management believes that the stock price, is at least fairly valued, right? The management would probably not like to repurchase shares if the stock price is too high. Right? So a repurchase also gives a positive signal about valuation. What about dividends? Suppose a management tries to do this with dividends. Does the dividend depend on the stock price? Would you be able, or let me put this another way. Would an increased dividend also signal that the stock is undervalued? No. Right? So dividend is a less powerful signal about valuation than a stock repurchase, right? So the stock repurchase has this additional advantage, right? That it can allow managers to signal that the stock is undervalued, or at least that it's fairly valued, right? So smart managers, right, should not be buying back stock when the stock price is too high, right? And everybody understand why dividends don't have the same effect? I mean, when companies pay dividends, investors just get the dividend. The amount of dividends that investors get don't really depend on the stock price, right? So there is no signaling, there is no valuation signaling effect. You might be signaling future performance, but you're not signaling valuation. Okay? And then finally, there is another story, and this is also the, so academics tend to see this as the dark side of stock repurchase, as I'm going to explain in a second. So it turns out that stock repurchases are a very good way for companies to manage earnings. And that is because the main metric of profitability, at least in the US market, is what we call earnings per share. Okay, so investors could be focusing on different profit measures. You know, it doesn't have to be this one. But it turns out that for reasons that, quite frankly, I don't understand, that's the measure of profits that investors focus on. Okay, so it's earnings divided by the number of shares outstanding. Right? So what's the issue now? The issue is that when a company repurchases shares, right? As we discussed it before, the number of shares outstanding goes down. But there is no obvious effect on earnings, right? It turns out that if you do the accounting, earnings decrease as well because, for example, if companies are using cash, right, they lose the interest rate that they are earning on the cash balance, and that interest rate is part of your net income. Okay, so there is an effect. Or companies could be borrowing money to repurchase shares, and of course the interest payment reduces earnings. Okay, so there is an indirect effect, but if you do calculations and with the real world data, I'm not going to go over all the details here, but what you see is that for most companies, if the company's valuation is not too high, this depends on the price to earnings ratio, but for most cases, the stock repurchase will mechanically increase earnings per share. Right? And as we did in our example there, paying dividends doesn't really change the number of shares outstanding. Right? So if you do the same calculation for dividends, dividends either decrease earnings per share, right, because you're expanding cash, or maybe have little or no effect. So you cannot increase earnings per share by paying dividends. Right? Does that make sense? And it turns out that this in the real world, this incentive to manage earnings per share can be quite powerful. And for example, right, so let's think about the following example. Suppose that, analysts, right, you have financial analysts that are forecasting profits, and they like to focus on earnings per share. That's one of the focus measures that analysts look at. and try to tell investors what should we expect the company's profits to be. Okay? So let's say that the analysts have forecasted earnings per share for next quarter to be equal to $3 a share. But then, of course, the management of the company, right, there is a little bit of an asymmetric information problem here. The management, the CFO of the company will have a better sense of the exact number that the company is going to report. Okay? And let's say that the CFO realizes that the EPS is not going to be $3 a share, it's going to be a little bit lower. What should the CFO do? Yeah, one option, if you're worried about that, right? Actually, my first reaction would be, it should do nothing. It's a very small number, right? Why would the market care about this, right? Maybe just report, your earnings are lower than the analyst forecast, and people shouldn't care. It turns out that the market cares a lot about situations in which companies miss earnings. There is some evidence, mostly from accounting papers, but also in finance, showing that when companies miss earnings, you report EPS that is lower than the analyst forecast, investors react negatively to that for whatever reason. I don't think this has such a great explanation. But the market does seem to react negatively to instances in which companies report missing earnings per share. And this is actually a graph from a paper that I wrote. A lot of my recent research has been on stock repurchase, actually, and it's based on these earnings-driven repurchase, which I think is a problem, to be honest. But it's very clear in the data I'll explain this graph to you. It's very clear in the data that managers are, in fact, doing repurchase to manage earnings. Okay? And the way you can do this is by looking at cases like our example. You can look at cases in which companies were just about to miss earnings. So those are the blue dots to the left of zero. Okay? Those are companies that they were going to report negative surprises. Okay? You can calculate that using the quarterly statements. You can estimate which companies would have missed the earnings forecast if they had not done stock repurchase. So those are the blue dots. And then there are companies that, they report they would meet the analyst forecast no matter what. Even if you don't repurchase, you're fine. Those are the, I'm a bit daltonic, so that's orange, right? Yeah, those are the orange squares, okay? Colorblind. I can see the blue well, right? So you can see that, and what you see in the y-axis is the probability that the company does a stock repurchase in that quarter. And what you see there is a big jump. Okay, so when you go from slightly positive to slightly negative, there is a big jump in stock repurchase. Okay, so this is evidence that earnings per share are actually driving stock repurchase activity in the market. Okay, and in terms of our discussion, as we mentioned, you really can't do this with dividends, right? Any question on this? You really can't do this with dividends, and it seems to be a very powerful driver of payout. So when you look at the data, 37% of all repurchases are conducted by companies that are just about to miss the earnings forecast. Okay? And this is not, and then there are other people have done, this is not a paper that I wrote, but people have done other research on this. For example, this behavior is more likely to happen when the CEO compensation depends on earnings per share. So one story is that the reason why CEOs manage earnings is because they get paid if the EPS is higher than the forecast. Okay? And this is a little bit of a dark side of repurchase, right? But in terms of payout, it's an advantage for companies, right? To be able to have this lever to, to manage earnings, which you really can't do with dividends. Okay? So, and then, if people are interested, I can share some other other papers if you want to have a look. But this is basically this is the essence of the story. Okay? So now we can end here with, you see what time? Yeah, we might not be worth starting the new lecture today, so we can finish a bit earlier. So, right, so now what we're going to do is a horse race. Okay, we looked at, basically those are all the arguments we have in the academic literature, right? And you can do a race between the two forms of payout, right? So we talked about taxes, repurchase win, right? Signaling, repurchase win, because you can signal cash, but you can also signal valuation, right? Earnings management, repurchase win, that may be a sad victory, but it's a victory, right? And then cash management is a tie, because if the concern is to get cash out of manager's pocket, you can do this with both dividends and repurchase, right? So this is the essence of what academics call the dividend puzzle. We really don't know why companies pay dividends. It might seem like a surprising conclusion. Dividends seem to be such a natural object in financial markets, right? But we don't have a good argument. We don't have a good, strong argument for why companies should pay dividends. Maybe they should pay no dividends, and they should do stock repurchase. So here, there is some behavioral research. So, saying that the reason, the reason why companies still pay dividends is because investors like it. This is only half an explanation, right? Because saying that investors like it, then you have to think about why do investors like dividends. And but there is some research, for example, showing that senior citizens, older people like dividends because it seems to be a stable source of income. They could get the same income by selling shares, but then it's too much work, right? It's better to just get the regular cash through dividends. And then people have shown that in companies that are headquartered in areas that have older people living there, pay more dividends, for example. So there is some evidence that maybe it's for behavioral reasons. Okay? But in terms of rational finance theories, we really don't know why companies pay dividends. And one possible story, this is actually, I took part many conferences about repurchase because of my research, and this is actually a story, I heard this from the CFO of Southwest Airlines. It's one of the major airlines in the US, and she was telling me that the reason why Southwest doesn't do all payout with repurchase, is because of this market risk story that's partly because of this. Okay, so this is the story. So suppose that as we saw, PepsiCo is spending money, right? Is doing stock repurchase at $5 billion. The current stock price of PepsiCo is $94 a share. Okay? So let's say that the next year following the repurchase is a financial crisis. So the market went down by 20%. Okay? So of course it's not, the CFO of PepsiCo has nothing to do with it. It's driven by exogenous, right? It's a crisis. The negative market return, okay? But PepsiCo stock is likely to go down, right? I mean, if you probably saw the capital asset pricing model already, we can predict what would happen to PepsiCo stock price just because of market forces, right? If PepsiCo has a beta of 0.5, which is the beta at that time, I estimated that beta, then PepsiCo should have gone down by 10%. Okay? Just for the capital asset pricing model, irrespective of what the company does, the stock price should have gone down to 84. Okay? So here's the question. this is what the CFO Southwest was telling me. Should the CFO be blamed, right? Say, oh, you bought back stock at $94. Now the stock is 84. Why did you buy back stock? You wasted our money. Is it the CFO's fault? No, right? You shouldn't blame the CFO. Okay, but apparently, according to the CFO of a major US company, she was worried, right? She was worried that investors would actually blame her. If the stock goes down for exogenous reason that has nothing to do with the company, irrespective of the reason why the stock price goes down, managers get blamed if they buy stock at a high price. So that, according to her, was a reason why the company sometimes avoids doing stock repurchase, because they don't want to get blamed for buying the stock at a too high price and then getting pressure from investors. Okay, so that's a possible story. There is no, I don't think there is research on that, but there might be a reason why CFOs still like dividends. Maybe a combination of market risk, right, and some sort of a behavioral story may help explain why dividends are still around. Any question on this? I think that's it. Yeah. Any question on payout? Yeah.
I have a couple of questions. The first one is, dividends payments are decided only by management or also by the general meetings, so may also by major shareholders?
Yeah, so the major shareholders will have a say on the dividend policy.
But actually, if the sense is not paying dividends, what's the sense in buying equities if you do not earn anything in exchange? I mean, you buy shares, you pay, but then in 10 years you do not gain anything, so why buying shares? So I think there is a necessity to buy dividends to keep shareholders.
Well, I mean, you are right in the sense that the value of the company doesn't necessarily depend on whether you're buying back shares or not. It really depends on your underlying business, right? So the reasons why companies repurchase shares, I mean, one strong reason is the valuation story, right? That the repurchase, if the manager believes that the stock is undervalued, then buying shares can be a way of increasing the stock price. So the market realized, maybe we're undervaluing this stock, right? And it's also a way of controlling cash, right? So if you let the cash, the alternative of not doing a stock repurchase for a company that has a lot of cash is to let the cash accumulate, right? And then investors don't like that because it might lead to agency problems. So the board of directors, for example, using your example, might get concerned if the company starts accumulating too much cash, because that might give the managers power to make bad investments that they wouldn't make otherwise. So the board of directors can act in the interest of the shareholders and force the company to pay out. Okay? Any other questions? All right, so let's end a bit earlier today, because now we're shifting to another topic, so I don't think it makes sense. We'll talk. So in the afternoon we're going to talk about risk management. Okay, thank you.